Welcome to The Explainer. Today, we're going to crack open the first book of the CFA curriculum. But we're not here to study for a test. We're here to find the hidden code, the powerful mental models that financial pros use to make sense of a really complicated world. Okay, let's just get one thing straight right from the start. When most people hear CFA, they think of a gigantic math test, right? Endless formulas, a calculator on fire. But honestly, that completely misses the point. What if the whole point isn't to turn you into a human calculator, but to actually upgrade the way you think, to install a brand new mental operating system for making tough decisions when the future is blurry? So let's zero in on the three core ideas that are the foundation of this entire system. And that brings us to our first section. We have to get beyond the formulas. Because at its heart, finance isn't really about the math. It's a system designed to solve a few very fundamental, very human problems. And the first, most basic challenge of all, it's the problem of time. I mean, think about it. We live our lives right here, in the present. But our biggest, most important financial decisions, like saving for retirement or starting a business, they all hinge on outcomes that are years or even decades down the road. Let me ask you this. A guaranteed $1 million, but you gotta wait 30 years for it. Or $100,000 right here, right now, in your hand. How do you even begin to make that choice? It feels impossible. It's like comparing apples to, spaceships. The solution is this incredibly profound mental model, the time value of money. And this is so important. This isn't just a formula, it's a core concept. The best way to think about it is like a universal translator for money. It lets us take value from any point in time and translate it into a language we can understand today. And the engine for this financial time travel, well, it's this relationship between present value and future value. Now, don't get hung up on the formula you see on the screen. The big idea is that we can do something that feels like magic. We can take that $1 million from 30 years in the future and figure out what it's worth in today's money. That's its present value. Or we can take the 100 grand we have now and see what it might grow into, its future value. All of a sudden, we're not comparing apples and spaceships anymore. We're comparing apples to apples. We're on a level playing field. Okay, so our new operating system can handle time. Fantastic. But there's an even bigger problem we have to tackle, and that's the problem of uncertainty. You know that guaranteed $1 million I just mentioned? Well, in the real world, almost nothing is guaranteed. The future isn't some fixed point on a map that we're heading towards. No, it's more like a fog, a whole range of possibilities, a spectrum of things that could happen. And this slide just illustrates that mental leap perfectly. Amateurs, they think in terms of certainty. They try to predict one single outcome. This company's stock is going to hit $100, but a professional knows that's a fool's game. They see reality for what it is, a distribution of probabilities. They're not trying to predict the future. They're trying to map the whole range of what could happen. So how in the world do you make a decision when you're staring into that cloud of possibilities? You use the next mental model, expected value. Now, the name here is a little misleading. It's not the one outcome you expect to happen. It's really the weighted average of all the possible outcomes. It's a tool that helps you find the rational center of gravity in an uncertain future. And that's so important because our brains are terrible at this naturally. We're wired to be overconfident or way too afraid of losing. This tool gives you a logical way to act. And a tool like this, probability tree, is how professionals actually visualize that messy uncertainty. Just look at it. It's not a crystal ball for finding the one right answer. It's a map. It's a map of potential futures. It forces you to think through, okay, if the economy does well, what does that mean for everything else down the line? It's a dynamic tool for thinking, not a static prediction. All right, so we can translate value across time and we can navigate uncertainty. But our mental operating system needs one final crucial piece. We have to solve the problem of context, because no investment, no company, no decision ever happens in a vacuum. This old saying just captures the idea perfectly. You could do the most brilliant analysis in the world and pick the absolute best-run company out there, the strongest ship in the harbor. But guess what? If the tide goes out, your ship is still going to be sitting in the mud. And in finance, that tide is the big picture, the macroeconomic environment. So what controls these big economic tides? Well, it basically boils down to two major forces. On one side, you've got fiscal policy. That's governments using their power to tax and spend to influence the economy. It's powerful stuff, but it's often slow and political. On the other side, you have monetary policy. This is wielded by central banks, and their main tool is tweaking interest rates to change the cost of money itself. Let's just focus on monetary policy for a second. It sounds incredibly complex, but the way it works is actually a pretty logical chain reaction. Step 1. The central bank adjusts one key interest rate. That changes how much it costs big banks to borrow money. That, in turn, changes the interest rate on your mortgage or a business loan. And that one simple change ripples out and influences millions of spending decisions across the whole economy. Understanding this context, well, that's the final piece of the puzzle. Okay. So let's put it all together. Time, uncertainty, context. What does it actually look like to think like a pro using these three models? Here's the most important shift in mindset. It's not about being right. It's not about having a crystal ball and predicting the future perfectly. That is impossible. The real goal, the achievable goal, is to be consistently less wrong over and over again. So this is it. This is the operating system we've been building. First, you stop seeing the future as a single prediction and start seeing it as a range of probabilities. Second, you use the time value of money as your universal translator to bring all those possibilities into today's terms. Third, you're always aware of the bigger system, the economic tides you're floating in. And finally, and this might be the most important of all, you treat your ideas like a map, not a treasure chest. It's a living map of reality that you are constantly, continuously updating as new information comes in. So you see, the real CFA isn't a math test. It's an upgrade to your mental hardware. It's a powerful new lens for looking at the world, one that helps you structure your thinking around time, uncertainty, and context. So the only question left is, now that you have this lens, what do you see differently? You know, a lot of people think that getting your CFA charter is all about cramming formulas to pass some ridiculously hard exam. And yeah, the exams are tough, no doubt about it, but that's not the real point. The whole goal is to install a powerful set of mental models, a totally new way of seeing the financial world. Today, we're going to unlock 3 of those core ideas. So let's dive into the first one. When you think about high finance, what's the first thing that pops into your head? Is it the frantic search for that one stock that's about to go to the moon? You know, the secret tip, the hidden gem. That's the image we all have, but honestly, it's mostly a myth. The professional approach is way more structured, and it all starts with a completely different question. Look, the real game isn't about trying to eliminate risk. That's just impossible. It's about understanding it, measuring it, and most importantly, making sure you're getting paid to take it on. It's a huge shift in thinking. You're moving from just hunting for winners to building a resilient system. And that system is built on one of the most powerful ideas in all of finance. You've probably heard the saying, there's no such thing as a free lunch, right? Well, modern finance basically found one, and it's called diversification. Now, it's an idea you've heard of a million times, but its true power is usually misunderstood. It isn't just about owning a bunch of different things. It's about how those things move in relation to each other. So take a look at this. It lays out the most fundamental trade-off in investing. Broadly speaking, if you want a higher average return, you have to be willing to stomach more volatility, more risk. You can see small cap stocks way up here, with huge returns but also huge swings. And then you've got T-bills way down at the bottom, super safe, but you're not getting much return. This looks like a hard and fast rule, one you just can't break. But what if you could break that rule? The secret sauce here is something called correlation. It's really just a number that tells us how 2 different assets move together. So if your stocks and your bonds both shoot up when the economy is great, and they both tank when it's bad, they have a high positive correlation. But if one tends to zig when the other zags, their correlation is negative. And that, my friends, is where the magic happens. And this is where you see the free lunch in action. It's awesome. When you start combining assets that aren't perfectly in sync, you don't just get the average of their risk and return. The risk of the whole portfolio is actually less than the average. Just look at how that line bends to the left. You're literally pushing into a new zone of better outcomes. You're either getting less risk for the same return or more return for the same risk. So diversification doesn't just cut risk, it creates a whole new superior menu of choices for you. Okay, so we've established that we can build a better, more efficient portfolio by combining different assets. But this leads to a really profound insight. Not all risk is created equal. In fact, the market has basically decided that some risks are your problem to deal with and others, well, they're not. Let's think about it like this. Unsystematic risk is like a leaky roof on one house. For that one homeowner, it's a huge pain, a big problem. But if you own 1,000 houses all over the country, a few leaky roofs are just a predictable maintenance cost. You can diversify that problem away. Now, systematic risk, that's a whole different beast. That's like a Category 5 hurricane or a massive economic recession. It affects all the houses. You can't diversify away a storm that hits the entire coast. Seriously, this graph right here is one of the most important charts in all of finance. It shows you exactly what happens when you add more and more stocks to a portfolio. That company-specific leaky roof risk just plummets. See? After about 30 or so randomly picked stocks, it's pretty much gone. But notice how the line flattens out. It doesn't go to zero. What's left over is that stubborn economy-wide storm risk that you just can't get rid of. That is market risk. And this, right here, is the big takeaway, the punchline. Since diversification is so easy and basically free, it's that free lunch, remember? The market is not going to pay you extra for taking on a risk you could have easily gotten rid of. Why on earth should you get a higher return for holding one super risky stock when you could have held 30 and basically eliminated that specific risk for free? The market only compensates you for taking on the risk that nobody can escape, systematic risk. Okay, so if systematic risk is the only risk that really matters for our expected return, how do we measure it? And maybe more importantly, how do we know if we're getting a fair price for taking it on? This is where everything we've talked about comes together in one beautiful, elegant framework. So let me introduce you to beta. And don't think of it as some scary formula you have to memorize. Think of it like a risk thermometer. All it does is tell you how sensitive a particular stock or asset is to that big economy-wide storm. If a stock has a beta of 1, it tends to move right along with the overall market. If its beta is 2, it's usually twice as sensitive, big swings up and down. If it's 0.5, it's a bit more stable. It's purely a measure of an asset's exposure to that non-diversifiable systematic risk. And now this is where it all clicks. We take that beta measurement and we plot it on this line, the security market line, or SML. This is the grand unifying theory. You can think of it as the market's official price list for risk. On the vertical axis, you have your expected return. On the horizontal axis, you have your systematic risk, measured by beta. The line tells you exactly what return you should expect for any given level of that systematic risk. Think about what this means. Every single investment, from an individual tech stock to a massive mutual fund, can be judged against this one line. If an asset is priced correctly, its combination of expected return and its level of systematic risk will put it right on the SML. It's the universal benchmark that brings a beautiful, logical order to what seems like a chaotic world of asset prices. So let's just take a step back. What have we really done here? We've moved away from the chaotic, messy idea of just picking stocks to a logical, 3-step framework that professionals actually use to think about the markets. It's a complete mental model. So first, you use diversification to create the best possible menu of risk and return options. That's your free lunch, right? Second, you recognize that the only risk you're actually going to get paid for taking is systematic risk, the kind you can't get rid of. And then third, you pull out your map, the security market line, to act as your guide to see if you're actually getting a fair price for that risk. That's it. That's the core logic. Now, this framework doesn't give you a magic crystal ball, but it does give you a powerful new lens to see through. It completely transforms the goal from just trying to find a needle in a haystack to actually understanding the structure of the haystack itself. So now that you can see this underlying system, how does that change the way you think about value, risk, and maybe even the big financial decisions in your own life?
You ever look at a company's financial report and feel like you need a PhD in advanced math just to get through the first page? Yeah, you're not alone. But here's a little secret the pros know. Finance isn't really a math problem, it's a language. And today, we're going to learn how to speak it.
So you can forget the calculator. Honestly, the most powerful tool in finance is more like a magnifying glass. Because the real skill isn't about running the numbers, it's about interrogating them. It's about being a detective and uncovering the story that's hidden deep inside all that data.
All right, so grab your detective hat. Here's what we're going to do. We're going to crack the code of what finance is actually about. We'll learn the rules of the game, expose a huge illusion that trips up a ton of investors, and by the end of this, you'll be thinking just like a seasoned analyst.
When you strip it all down, finance is just about making smart decisions with money. And those financial statements, they're basically the instruction manual. You have to see them not as just a jumble of numbers, but as a roadmap to help you navigate the pretty complex world of investing.
You know, this right here really gets to the heart of it. A financial report isn't some dusty old history book. It's a living document that's all about the future. It's a tool that helps you answer the single most important question in finance. Okay, so what's next?
Any good detective knows you can't solve a case if you don't understand the law. Well, in finance, the law is the language of accounting. It's the whole set of rules that governs how companies get to tell their stories. So let's dive into that rule book.
And here is the first big, and I mean big, aha moment. Financial statements are not objective facts. They're not gospel. They are much more like a carefully crafted story. A story told by a company's management. And just like any story, it can be interpreted in a bunch of different ways. The numbers themselves don't lie, but how they're put together can definitely tell different versions of the truth.
Think of it like the difference between British and American English, right? They're both English, but they have slightly different spellings, some different words, different ways of saying things. Well, the same is true for accounting standards. Under IFRS, a company might value its assets one way, but under US GAAP, it could be totally different. Same company, but the story it tells changes just a little bit depending on which dialect it's speaking.
Now, without rules, the whole game of finance would just be chaos. And that's where the regulators come in. You can think of them as the referees of the financial world. Their whole job is to make sure everybody plays by the same rules, so that investors like you and me can actually trust the information we're getting. Honestly, without them, the whole system would just fall apart.
The headlines might tell you what a company did, but it's the footnotes that tell you why. And that's where the real juicy stuff is. So here's a pro tip for you. Always read the footnotes. I know, they're not the most exciting part of a financial report, but they are almost always the most revealing.
Okay, and now for the main event. We are about to uncover the single biggest illusion in all of finance, the one that has brought down countless companies and fooled even the smartest people out there. It's the great disappearing act of profit, and it all boils down to one simple question. Where's the cash?
It's kind of like this. Let's say you do a job for a client, and you send them an invoice. You've earned that money, for sure, but you haven't been paid yet. Accrual accounting says you get to recognize that revenue right away, even though the cash is still sitting in your client's bank account. And that, well, that's where the trouble can start. Okay, picture this. You're a construction company. You land a huge $10 million contract. You're thrilled. You get to work, and by the end of the year, you've spent $4 million and you're about halfway done. Now here's the magic trick of accrual accounting. You can actually book $5 million in revenue even if you haven't seen a single penny from the client yet. So on paper, you look like a hero. But in reality, you might be bleeding cash. So the company's income statement, it's a thing of beauty. Profits are soaring, investors are happy, the CEO is on the cover of magazines. But there's this dark secret just lurking beneath the surface.
And that secret is the company is running on fumes. Because while all those paper profits are rolling in, the actual cash is going out the door. And at the end of the day, you can't pay your employees with profits, you can't pay your suppliers with profits, you can't pay rent with profits. You can only pay them with cold, hard cash.
So now we know the two golden rules of financial detective work, right? Know the law and follow the money. But how do you actually put these rules into practice? How do you spot the clues that tell you, something's not quite right here? That's what we're going to dive into next.
It's really all about looking for anomalies, things that just don't quite add up. For example, if a company's revenue is rocketing up at 50% a year, but all of its competitors are chugging along at 5%, that's a red flag. Now, it doesn't automatically mean the company is doing anything wrong, but it is a huge sign that you need to dig a little deeper and find out what's really going on. Let's put you in the CEO's shoes for a second. Your company just spent $1 million on some fancy new software. Now you have a choice. You can either report that entire expense all at once, which will make your profits look pretty terrible this year, or you could spread that cost out over the next 5 years, which will make your profits look amazing right now. So what do? It's a tough call, and it's a perfect example of how management can use accounting rules to really shape the story they want to tell.
You should think of the Management Discussion and Analysis section, or the MD&A, as the director's commentary on a DVD. It's where management gets to explain their creative choices and give you their take on the story.
But just like a director's commentary, it's not always the whole picture. You still have to watch the movie for yourself and make up your own mind.
Okay, so we've learned the rules of the game, we've busted the great profit illusion, and we've learned how to read between the lines. So what does this all add up to? It means we're no longer just passive consumers of financial information. We're active, critical thinkers. We are, in fact, financial detectives.
This right here is the secret that separates the amateurs from the pros. The pros know that the numbers on the page are just the beginning. The real story is in the choices, the assumptions, and the judgments that lie just beneath the surface. And once you learn to see that story, you will never look at a financial report the same way again.
So what's the big takeaway here? It's actually pretty simple. Be curious, be skeptical, and always, always read the footnotes. Because the truth is out there, but you have to be willing to look for it. So, the next time you open a financial report, don't just see a bunch of numbers. See a story of triumph, of struggle, of innovation, of risk. And know that you now have the tools to not just read that story, but to really understand it, to question it, and maybe even to write your own.
All right, let's jump right in. When you look at the world of high finance, it can feel like this impenetrable fortress of crazy math, right? Something only a handful of people can ever really understand. And a lot of people think that earning a CFA charter is just about memorizing thousands of formulas. But that's not really the whole story. See, the real point of the CFA program isn't just to turn you into a human calculator. The goal is to install a new operating system in your brain, a completely new way of looking at the financial world. It's about getting a handful of really powerful, foundational ideas that explain how money and risk actually move around the globe. So what we're going to do is walk through 3 of these core ideas. These are the absolute building blocks for pretty much everything, from a simple loan all the way up to the most exotic derivative. Once you get these, trust me, the rest of the financial landscape starts to click into place. Okay, so our first huge idea is something I call pricing promises. You see, at its very core, a massive chunk of the financial world runs on one simple thing, a formal, legally binding promise to pay someone back. And that's basically what a bond is. It's not some mystical, complicated thing. It's really just a standardized tradable IOU. Some big entity like a company or a government needs cash to do stuff, so it makes a formal promise to investors. Hey, lend us your money now, and we formally promise to pay you back down the road, plus some interest for your trouble.
So you've got 2 sides to this deal, right? On one side, you have the lender, we call them the bondholder, and they're the one buying that promise. On the other side, you've got the borrower, the issuer, who's selling the promise to get the cash they need. This simple exchange is the fuel for almost everything in the economy.
But, and this is a huge but, not all promises are created equal. I mean, not even close. The promise from the US government is a whole lot different than the promise from a shaky tech startup. So the market needs a way to figure out, okay, how reliable is this promise compared to that one? That right there is the entire concept of risk.
And this is a great way to see how the pros look at it. They basically map out this entire universe of promises on a grid. On one axis, you have how long until the promise is due, that's its maturity, and on the other, you have how likely it is they'll actually pay you back. That's its credit quality. Everything from a super safe government bond to a risky junk bond fits somewhere on this map.
So that leads to a pretty obvious question, right? If you're the one lending the money, how do you protect yourself? How do you make sure that promise actually has some teeth?
Well, it all comes down to the rule book. Every single bond is backed by this dense legal contract called an indenture. And inside that contract, you'll find all sorts of rules or covenants, things the borrower has to do and things they can't do. Sometimes they even have to pledge specific assets as collateral, so if they break their promise, the lenders can just take the assets.
Now, to make all this complexity a little easier to handle, we get a kind of scorecard. You have these credit rating agencies, and their entire job is to dig through all that fine print, analyze the borrower, and boil it all down to a simple letter grade, from the super safe AAA all the way down to D for default. It makes this abstract idea of risk something you can actually see and compare. All right, so we've got the basic building block, the individual promise. Now let's take it up a notch. What happens when you start bundling thousands of these promises together?
This whole process is called securitization, and it's kind of like financial alchemy. So look at this. You have an originator, let's say it's a bank making thousands of car loans.
They take that giant pile of loans and sell it off to a totally separate legal entity. That entity then turns around and issues brand new bonds to investors, and the payments for those new bonds come from all the people paying off their car loans every month.
So the process really boils down to this simple three-step recipe. First, you originate the loans. You create a big pool of them. Second, you isolate them in what's called a special purpose entity, which is crucial because it protects the loans even if the original bank goes bust. And third, you issue new bonds called asset-backed securities using that isolated pool as the engine.
But here is where the real magic happens. This isn't just about bundling things together. The true innovation is how you can slice and dice the risk from that one giant pool of loans.
They do this using what's called a waterfall structure. Just picture it. All the cash from those loan payments flows in from the top. The safest slices, the senior tranches, get first dibs on that cash, so they're low risk, low reward. But then you have the riskier slices at the bottom. They're the first to take a hit if people stop paying their loans. But to convince investors to take that risk, they get paid a much, much higher interest rate. But see, packaging promises like this creates totally new and kind of weird kinds of risks for investors. Think about it. If interest rates drop, what do people with mortgages do? They refinance, so they pay you back way sooner than you expected. That's contraction risk, because now you have to reinvest that cash at lower rates. On the other flip side, if interest rates shoot up, nobody refinances. That's extension risk, because now your money is stuck in that low-rate investment for way longer than you wanted.
So we've priced promises, we've packaged promises, now for the final and maybe the most mind-bending leap of all. What if you could literally separate the risk from the promise itself and trade it all on its own?
I mean, really think about that for a second. What if you could make a bet on where the price of oil is going without ever buying a single barrel? Or bet on the direction of interest rates without ever owning a bond? Well, welcome to the wild world of derivatives.
And this quote really nails it. At its core, a derivative is just a contract that lets you pass a specific risk from one person who doesn't want it to another person who's willing to take it on, hopefully for a profit. And really, people use these for two main reasons. On one side, you have the hedgers. Think of a farmer. She's worried the price of wheat will crash before her harvest. So she can use a derivative to lock in a sales price today, getting rid of that risk. Then you have the speculators. They aren't growing any wheat. They're just betting that the price will go up and they can make a profit. So that's all a derivative is. It's just a contract whose value is, literally, derived from something else, a stock, a bond, a commodity, whatever. And this is huge because it means you can isolate, price, and trade the risk of almost anything you can imagine. All right, let's tie this all together. Because when you take these three big ideas, pricing promises, packaging them up, and trading the risk itself, you start to see the entire financial world in a completely new light. You start to see it like a professional does. You know, a pro doesn't just see stocks and bonds. They see this incredibly complex, dynamic web of promises. They see how you can package those promises to reshape risk, and then they see how risk itself can be stripped out and traded like its own asset. These are the Lego bricks that the entire global economy uses to move money and risk to the places where they can be used most effectively. Which leaves us with one last, and maybe the most important question of all. This whole incredible system, this entire universe of promises we've built, it all rests on financial models that are trying to predict the future. But what happens? What happens to the whole system when the models are wrong?